These presentations will work a comprehensive bookkeeping problem both within Excel as well as within QuickBooks. Excel having the advantages of being able to see all the components and how all those components fit together to make the end product, that end product, the financial statements. QuickBooks having the advantage of being able to use forms, simple data input, and an automated system in order to convert that simple data input into the end product, the financial statements. We will work each component of the problem in Excel first and then work that same information in QuickBooks. Hello, in this presentation we're going to enter a transaction for the recording of loan payments into our bookkeeping problem in Excel, keeping in mind how this same information might be input into accounting software such as QuickBooks. If you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. We're going to look at QuickBooks first and then jump back to Excel and put this information into Excel. We're going to put information related to a loan payment. So the first thing we need to do is break out what that payment contains. What is the arrangements of the loan? When we make the payment, what amount is it that will be applied to principal versus interest? So first we're actually going to look at the amortization table. This is something that may be given within the loan. The loan may give the amortization table, or a loan may just give the terms, and all we really know is the payments and the interest rate, the amount of the loan, and the amount of payments. Then if we know that, we can derive the payment amount as well as the table, and we'll take a look at how to do that. Once we have that information, the amortization table looking something like this, in this case, we're saying we have the loans that's going to be all the same, kind of a car payment type of loan, or if we're making a loan on a mortgage, we would have the same type of concept where the payments remain the same, but the amount allocated to principal and interest differ. If we were to input this information into QuickBooks, we would do something like this. We're going to enter it into the register this time. We could write a check, but we'll take a look at the register and put it directly into a check register. And that will be something looking fairly familiar. So if we scroll down, if we went to QuickBooks and went to banking and used the register, then we look at the checking account register, then we can enter this data. Now the register may not look quite as familiar since we only see one transaction, but it's going to be familiar to if we were going to write a check by hand and put it into our checking account register. We have the date of the check, which is February 1st, and it's going to go to Chase. The amount is for that amount on the table, the amount of all the payments. But then we had to use the split icon because it's not going to one other account. We can't just reduce, for example, the loan payable because there's an interest portion and a principal portion to this payment. So we got to record both the interest, and this is insurance. It should be interest expense of the $300, and then the loan payable would be the difference. So this is one way we could record that first check in, and in order to do this, we need to know what those two amounts are. Which we don't always have the amortization table for, and we can make that. We'll produce that, and then we need to be able to post that out. If we did that for the second payment, we would have the same thing, the same check. In this case, we wrote a check for it, just to show a separate item to do that. We're writing a check. We have the check amount here, same amount for the check, and this should be interest expense. The interest expense portion changed as compared to the loan payable. So we have those three accounts. We're going to see those same items as we enter these two items into our Excel problem. Within Excel, we're first going to look at what we're talking about in terms of the amortization table, and then we'll get back here and put this information in. Note what we have here is a $72,000 loan. We're going to say that that's all one loan, and what the terms of the loan, we'll give the terms of the loan. And we'll give the idea that we got the terms of the loan, but we don't have the amortization table, and we'll produce that to see how it's made, and then that'll give us some idea as to why we have to break up this payment in a little bit different way than we might first think when we put in this information. So I'm going to scroll all the way to the right, and we're going to have an amortization table that we will put together. So we're scrolling all the way to the right. And we're scrolling all the way past that to the loan payable. And I'm trying to keep all this on the same tab so that we can move back and forth and use formulas between them. So here we have our information. Now, when we take a loan out, they're probably going to give us this information, and they might not give us the amortization table, which we can then derive. So we'll produce that now. So we have the loan, which is $72,000. We have the monthly payments, which we're saying are $60, and the rate we're saying is 5%. So if we're going to give this as the type of loan that we make an even payment over 60 months, 5 years, every month we make an even payment until the loan is down to zero, but we have to factor in that interest, the rent, in essence, on the money that we are borrowing, then one, we're going to make that payment amount. This is something often given in the loan terms, but it's a calculation that we can put together here in Excel. Common type of calculation that's useful to have, and we can use a function to do it. So we'll find the payments based on this information first, and then we'll go down and make the amortization table, because that's not going to be all the information we need. We need more than the payment. So in order to make the payment, we're going to do a function here and use this information to figure out what a payment would be if we had to make 60 payments at 5% and pay off a $72,000 loan. So we're going to say equals, and the formula is PMT, payment, and we can double click on this item here or just select brackets, Shift 9. I'm going to double click on it. And then it gives us our items here. So every time it says, it gives us a little cheat sheet. We want the rate, comma, and then the number of payments, comma, and then the present value. So all we're going to do is pick up that information. The rate is that. Tricky thing, however, is the rate is going to be over the time period we're talking about. Whenever we have a rate, that 5% means 5% a year. What we really want here, though, is the rate per month. So what we need to do is take that rate and divide it by 12 months. So that's going to be the most confusing part of these types of formulas, to make sure that we get the proper rate for the time period. Most people not really understanding what rate means. And if we were really to tell someone a rate, such as a mortgage rate on a house was 5%, we would really be saying it's 5% a year, even though we're making monthly payments. So that terminology can be a little bit confusing. So that is the most confusing part. Then we're going to say comma, and then it says we need the number of payments in pair. So that's going to be the payments. That's going to be, or that's periods, number of periods, payment periods in our case. So we're going to take 60 of them, and that's going to be that. So we're going to say comma. And then we want the present value. That's going to be the amount at the beginning of the loan, the $72,000 loan. And that's all we need. So we can close it up or just hit enter right now, and it'll give us the payment. Now note that it put a negative number there. That's just a function of the formula. If we want it to be positive, we could double click on it and put a negative before the P. And that'll just tell Excel, hey, take whatever you did and flip the sign on it. So that'll make it a positive. Now, if you wanted to see that again, here's what we did. Here's the formula. You could type it in exactly. Negative PMT brackets D4 slash or divided by 12 comma DT comma DT2. Let me say that again. PMT brackets DT4 divided by 12 comma DT3 comma DT2 and enter. There's also a payment field up here that if you wanted to do that with a little bit more help in terms of the box that they give you some more kind of hints, you could go to the formulas tab up here and choose this item. So we're in the formula tabs, we're in the function library, and we're going to insert function and then type in that you want payment. And it should give you the payment right there, and it'll tell you that this is a calculation for the payment. And then if you select that item, it'll give you a bit more of a formulaic box. In essence, it's really the same thing that we had, but it'll tell you that take the rate here. You can see the formula being built here, and it'll give you more of a description in terms of what they're talking about here. So for example, it tells you, take the 6% divided by 4 and tries to tell you what we were talking about in terms of the interest rate. So that's going to be that. Closing that out. This is good information because when we write the check, of course, that's what we're going to write the check for. This is often what they give us in the loan terms. What they don't give us is going to be the amount of interest and principal per payment, an amortization table. So we're going to make the amortization table now. We know what the payment is. It's always going to be equal to, I'm in DR9, I'm just going to put equals that number. That's the number of payments, or that's the amount of payment. Enter. The interest, I'm going to say, is going to be the principal times 5% divided by 12 though. So remember that we're talking about the interest rate is for a year. So if we take the interest, we're going to say it's the 72,000 in this case, times 5%, 0.05, gives us 3,600, but that's for a year, and we want for 1 month. So if I divide that by 12, we get 300. So I'm going to do the formula for that. We're going to say this equals this 72,000 times 6%, but then divide that by 12. So it's this times that divided by 12, enter, 300. Then we're going to say the reduction of principal. If we're paying that and this much is going away, that's just kind of the rent on the money, we're never getting that back, it's not reducing the principal, then the difference between this minus that, reduction in principal. So we'll say that this equals this number, the payment, minus the amount that is interest, and enter, that's the reduction in principal. And then the new principal, the amount of the loan then after this payment, is this amount minus the principal reduction. So we're going to say this equals the 72,000 minus the principal reduction. Now we're just going to repeat this process all the way down. So we're going to say the second payment is the same. That never changes. I can do that all the way down. This is always going to be equal to that. So I'm just putting an equal sign. So I'm just going to say this, and 4 is going to be equal to this payment. And the nice thing about that is that we can copy that down. If I autofill that down, QuickBooks will just put that same number all the way down. So I'm going to put my cursor on this little icon so it looks like that, not like that, but like that, and then drag that all the way down. There's going to be 60 payments. We're going to go all the way down to 60 payments way down there. And it'll all be the same. So that we can just autofill off the bat. The interest is going to change, however. It's always going to be based on the new principal, and that's going to be a changing factor. So we're going to have to say the interest this time will be equal to this number times 5%, and then we have to divide it by 12. And that gives us 296, a little bit lower than this interest because the principal has been reduced. And then the principal reduction is going to be the payment minus this new interest, equal to, in DT10, the payment minus this interest, enter. And therefore the new principal is going to be the prior principal minus the new principal reduction. So this will equal this principal minus the principal reduction, gives us the new principal has been declined. And now we're just, it has declined in value. So now we're just going to keep doing this on the way down. So we got the new interest, the payment is still this, the interest then is going to be equal to, and we won't do this manually the whole way down. We will autofill it after the next time here. So it's going to be that times the 5% divided by 12, enter. It's a little bit lower. Then we're going to say the new principal is going to be the payment minus the interest equals the payment minus the interest, enter. And that means the new principal then is going to be the old principal minus this item. So this equals the old principal minus the principal reduction. Enter. Now we're going to do this one more time, and we're going to try to think about how can we put this in place so that when we copy it down, it does what we want. In other words, if I was to highlight these 3 cells and autofill it down, would it do what we want? And let's try that. I'm going to try that one time and see if it does. And then I'll build another row in a way that I think will work. So we're going to put our cursor there and just copy it 1 row down and then just check all the numbers. So the fact that it has a bunch of meaning the cell is too small is not a good sign. So if we double click on it, it took this number, that looks right, but then instead of taking the percentage, it took the cell underneath it because it tried to move the cell down with the copying of the formula. And that's really the problem. That's going to be the problem the whole way. This looks about right, actually, and this looks about right. So we're going to try to fix that. I'm going to delete these, and we're going to try to fix that problem. So we'll do this calculation one more time, keeping in mind that we want to copy this down and see if we can adjust this a little bit so that we can just autofill down. So we're going to say the new payment is going to be this, the prior payment, times that, and that number we want to go down. If I want it to copy it down, it should go down to the next cell. I don't need to do anything funny to that. I'm going to multiply it times this cell. This cell, we don't want it to move. When we copy it down, we want it to stay. We call that an absolute reference cell. So this cell is not absolute. When I copy it down, it's going to move down. We want it to stay. So what we do is we put dollar signs before, and I'm going to put it before both the DT and the 4. So I put a dollar sign, and it has nothing to do with money. This is just like a code for Excel. So a dollar sign before the DT, a dollar sign before the 4, and that'll say, hey, whatever happens, don't move that cell. Don't move it to the side, don't move it down. And then we just need to go to the end of that and divide it by 12. So same formula, except we put dollar signs in here and enter, and that's going to be the change we need. Now we're in the reduction of principal, which will equal the payment minus the interest, and enter. And we're going to have the new principal, which will remain once again equal to the principal minus the principal reduction, which will give us the new amount here. Now, if we copy this, I'm going to highlight these 3 cells. I'm going to copy it down and double check. I'm just going to copy it 1 cell down, double check. If it looks okay, we'll copy it all the way down. So we're just going to drag it down 1 cell and see if it does. I'm double clicking on the formula. Looks like it did what we want. I'm going to double click on this formula. Looks like it does what we want. Enter. I'm going to double click on this formula. It looks like it does what we want. So I'm just going to check it all. So now I'm going to copy, I'm going to highlight these 3 cells. And I'm going to autofill all the way down. And once we get to the bottom, this amount then should be 0. That's how we know that we did it correctly. So we're going to put our cursor here and just autofill all the way down. So we're going all the way down to 60. Once we do that, let go, and this should be 0. So this is going to be an amortization table. This will help us, 1, make the payment. I'm just going to scroll back up. We're going to start with this payment. We're going to make that payment. And then it'll also help us to break out the short-term and the long-term portion of the loan when we do the adjusting process. So now we're just going to write a check, and when we write a check, the amount will be for this, but then we'll have to write the other side to it, interest expense here, reduction of principal there. So let's go ahead and do that at this time. So we're going to scroll all the way to the right, scrolling all the way back. We're in our journal entry. And we're going to put the date here. The date is going to be 2/1. And we're going to say, is cash affected? We're going to say yes. The checking account is affected. It's going down. So we're going to do the opposite thing to it, which in this case would be a credit. So we'll copy this item. I'm going to put it I'm going to put it way down here, 2 cells down, because there's going to be 2 things above it, interest and reduction of principal. So we're going to put it way down here in B7. Right click and paste 1, 2, 3. I'm going to indent this by going to the Home tab, Alignment, and increase the indentation. Now the other side of it, we'll pull the numbers in a second, but the other side of this is going to be 1, the loan payable is going to decrease. We owe $72,000. That's what we're paying off. It's a credit balance. We need it to go down because we're paying off the loan. That's going to be a good thing for us. We do the opposite thing to it, therefore, which in this case is a debit. So I'm going to copy that. We're going to copy AJ20, scroll back up, put that in B5, right click and paste 1, 2, 3. Now the other thing that happens, of course, is that we have to pay interest on this. That's going to be an expense. So down here in the expense items, remember it's in order: assets, liability, equity, income, and expense. We have interest expense, and that's going to be a debit, as all expenses are, and it only goes up in the debit direction. Therefore, we will debit interest expense. So we're going to copy AJ20, right click and copy. Scrolling back up, we're going to put that in B6, right click and paste 1, 2, 3. That will be our journal entry. Now let's go pick up the numbers from our amortization table. To do that, we're going to freeze the panes. We'll put our cursor on AJ1, and then we're going to go to the View tab. We're going to go to the Windows group, freeze panes, freeze the panes. We're going to scroll all the way to the right. So we're scrolling all the way to the right. I'm just holding down the right arrow until we get all the way to DQ. We're picking up this payment. So we'll go ahead and highlight that now. I'm going to make that, I'm going to color it to green. And we are going to make the payment amount of $1,359. That's going to be the credit. Credit 1359. We're going to debit interest 300. So 300, and we're going to have the interest is here, 300, and the reduction in the loan is 1,059. So 1059. If we add up the debits, we highlight these, they add up to 1359, which is equivalent to the credits. Now I'm going to go all the way back and we'll post this. The quick way to go back is I'm going to put my cursor on this side of the freezed panes and then just hit the right arrow one time. So I'm right here on the D column and I'm just going to hit the right arrow or 2 times and then it goes all the way back over. Alright, so now we're going to post this. Here's our journal entry. We're going to journalize the journal entry starting with the loan payable. There it is on the journal entry. Loan payable is down here. It's the last orange account on the trial balance. Therefore, it will be the last orange account on the general ledger. So we're going to scroll. It's in order, assets, and then liabilities. And here we are. We're in the last liability. It's what we want. There it is. It's up at the top, actually. We are in the debit section. We're in BG8. So we're in cell BG8, and we want to pick up that 1059. So we're going to select equals, and we're going to post that 1059 and enter. So that brings the balance down to $70,941. Scrolling back over to our trial balance, we see that same amount, then $70,971 out of balance down here by the 1059 until we record the rest of this journal entry. Interest expense, next item. It's going to be way down here. Interest expense is way down here, so it's going to be way over to the right on our general ledger. Scrolling right, we have assets, we have liabilities, we have the equity, and then the income statement. Here, interest expense, we have here on BO22. So BO22, I'm going to scroll over a bit to the right so we can have it right next to each other. So BO22, interest expense. Be careful not to put it into internet expense, as I did just a second ago. And I'm going to scroll back up. We have to go and pick up this number, that 300. So we'll have to scroll just a little bit, or we can make this, I'm going to make it a little bit smaller. So we're going to tap down from 120 to 110. And here we are in interest expense. And we need to pick up that 300. So we're in BO22. We're just going to say equals and point to that 300 and enter. There's the 300. Going to bring us back up to 120 by selecting this item, back up to 120. Scrolling left, we're going to look for that 300 over here on the trial balance. So if we scroll down, there's the 300. That then brought down net income. We have a loss. That's the only thing we have so far, meaning revenue minus expenses mean that the debits of expenses are currently winning. Out of balance by the 1,359 until we record the check amount. That checking account, first account on the trial balance, therefore first account on the general ledger. We will be here in AN8. We are in AN8 equals, point to that 1,359, bringing this balance down from 94,437 down by 1,359 to 93.78. That 93.78 then found here as well on the checking account. We're going to do this same transaction now for the second journal entry just to show the difference in the two transactions in terms of the loan payment and the interest as we record it. In order to do that, we're going to jump to the end of the month. And this is a little bit strange. We're going to be a little bit out of order. When we post this, it's going to be a little bit out of order on the general ledger, so bear with us on this. We just want to record the two transactions at the same time to see the difference. And so that's what we'll do here. So we're going to say on 2/28 then, we're going to record the loan payment at the end of the month and be able to compare and contrast them right next to each other, even though note that we're talking about a whole month apart of loan payment that we're recording at the beginning and the end of the month. Okay, so to do that, we're going to scroll all the way to our loan again. First, let's just, it's going to be these same accounts. I'm going to copy these same. I'm just going to highlight these same accounts, right click and copy and put them right here on B9, right click, paste 1, 2, 3. Same amounts. I'm going to adjust the formats, go into the home tab, make this one there, and I'm going to highlight these two, home tab, alignment, increase the indentation there. So the structure will be the same, meaning we're going to write a check, we're going to reduce the loan payable and record the interest for the other side. Scrolling all the way over to the amortization table then, we're going to scroll all the way back to the amortization table, just holding down the right arrow until we get to the loan amortization. We are now on the second payment, so here's the second payment. We'll make that, I'm going to right click, I'm just going to make it a different color so we can see it well. There it is. And we're going to say the payment then, same payment amount. It's going to be a credit, reducing the checking account, 1359. Then we're going to debit the loan amount though for 1063, 1063, and the interest is now 296. So there is that. Now we're going to post this, so it looks exactly the same, but notice it's a little bit different. Now we're going to post it here. I'm going to put my cursor right here, and I'm going to click the right arrow to go all the way back again. Note you can also on your keyboard select the home, and that'll take you to A1. So you can use that. I'm going to select keyboard just so you can see it, and then I'm going to go to the right, and that'll take us all the way back. Alright, so then we will record this out and post this. Note, I just want to point out at this point in time that if you don't have the amortization table, or if this is too confusing and you work with a CPA firm, you could make an arrangement with the CPA firm or whoever does your adjustments at the end of the month or the end of the year and say, hey, I have a loan. I don't understand this amortization stuff. I just want to write a check and put it to one account rather than two accounts and not have this adjustment that I have to make that changes every time because that's confusing. Then you could just say, hey, I'm just going to put all the other sides to loan payable, meaning I'm going to credit the checking account, and the other side, when I write the check, just goes to loan payable, and it's going to be for the same amount. And I would like you, as my adjusting department, to go in there and then fix the amount that should be allocated to interest versus the loan. And that's a very useful way, functional way to do it. It does mean that the loan payments won't be right. The loan payable amount won't be right until it is adjusted at the end of the month. But it's a way to simplify the process for the bookkeeping and then just make an adjusting process at the end. So keep that in mind if that's an option for you. But we're going to post this out now, starting with the loan payable. There's the loan payable. We have the loan payable down here. It's the last orange account on the trial balance and therefore last orange account on the general ledger. Scrolling to the right in order to find that last orange account. We see it here in BG, so we're going to be down here in BG 9, and we're going to say equals, and point to this 1063, bringing the 70,941 down by 1063 to 69,878. Scrolling back over, I'm going to scroll all the way back over, scrolling to the left, we see that same amount right there. Then we're going to record the interest. Here's the interest that we're going to record. Here it is on the trial balance. It's the interest expense, not the internet expense. It's going to be in the same order on the general ledger. So we're going to look for those dark blue accounts for the interest expense on the general ledger. Scrolling to the right, we see the interest expense here. If we scroll up just a tad, we can barely see it. There it is. We're in BO23. We're going to say equals that number. BO23 equals, point to that 296. That's going to bring the balance up from 300 by 296 to 596. Scrolling back to the trial balance, we're looking for that 596. Scrolling to the left, scrolling down, we see the 596 there. Then we're going to record the last piece, the checking account, reduction of the checking account. Here's the checking account here. We're going to be in the checking account in AN9. And just select equals and point to that 1,359 and enter. Brings this amount down to 91,719, that found here on the trial balance. Now we're just going to see what happens to our financial statements. First look in the financial statements for the new month. We did something to cash, so I'm just going to point that over there. We did something to the loan payable. Let's see what happened to our financials there. We did something to interest expense. Let's point that over and see what happens to the financial statements. Scrolling all the way to the right to the financial statements, we're just going to scroll to the right. We see that cash has been adjusted automatically. We see that our assets still equal our liabilities and equity. Our loan payable has been adjusted. Scrolling down to the income statement, we see that the interest expense is adjusted here, giving us a loss because we have no revenue yet. This is the first thing that has happened. And of course, this is interest expense for the first and last month. So keep that in mind as well. We recorded both of them just to see two payments. And then that net loss is in our statement of equity. And it's used to get our ending statement of equity amount, 143, $579. That also found on the balance sheet. Hello, in this presentation we're going to talk about how to make loan payments within QuickBooks Pro 2018. If you've been working along with us, that's great. We'll be working along with the Get Great Guitars problem. If not, that is okay. We'll show how to make a loan payment, including the recording of interest and expenses while making that loan payment. If you have the backup file up to this point, you can restore that by going to the File and Restore. That backup file or working through this problem and getting to this point will be helpful so that we're on the same page and working with the same data. But if that's not the case, again, that's okay. We can follow through this and get some relevant information from the process of recording a loan payment. What we're going to do is write a check for a loan payment. The tricky thing about that, however, is that when we write a check for a loan that we have taken out, there's typically going to be at least part of it allocated to principal and part of it allocated to interest. When that's the case, we're going to have to split the two accounts that that payment is going to, and we'll discuss about how to do that split and why we're going to do that split, and then what's it going to look like on the financial statements. So in order to do that, let's first look at what we have so far. So we're going to go to Reports on the drop-down. We're going to go to Company and Financial and look at the balance sheet in terms of the loan that we have at this time. I'm going to change the date to, I'm going to customize the date and make it for the year of 01/01/21, January 1st, 2021, and we'll make that go through 12/31/21, and okay, so we're going to be working in the future, and we have this balance here in terms of the loan, scrolling down to the liabilities, this balance here in terms of the loan. Now this is a loan that we took out and we're making payments on it. There could be a variety of different ways that the payment could be set up, that it's in accordance with the loan. It's not typically, it doesn't have to be, in other words, just like a mortgage payment in that we're paying principal and interest back on a monthly basis. That's one format of a loan. We might just be paying only interest back and paying the principal back at a later time, or many different combinations of that. However, let's take a look at a typical situation in which it'll be similar to a mortgage, where we have principal and interest payments being made on a monthly basis. And think about, well, when we make those payments, we can't just decrease cash and decrease the loan, because when we do that, what's going to happen is we're not taking into account the interest. And we can't just make the payment and record it all to interest, because when that happens, we're not taking into account the decrease in the principal. We're going to have to somehow split that out between the two. That is what we are working on here. In order to do that, we first need to know what that split is. And to have that, we need an amortization schedule. When we get the loan, we may not have an amortization schedule when we get the loan. We might just have the terms, and we might have to build that amortization schedule. So first, let's look at an amortization schedule. We'll actually make one and see what we're talking about, and then we'll take that information and record that here using the split and see what happens. Here is our data in Excel. So we have the data within Excel. We have the $72,000 loan. We're going to say it's for 5 years, and we're going to pay monthly. So 5 times 12 means we're going to make 60 payments, and we're going to say the rate is 5%. On a typical loan, that's going to be the type of information we have. We may or may not even know the payment. We probably know the payments too, but we're going to calculate the payments here. And then we may not know, what we don't know is the split between interest and principal per payment, because that will vary, that will change as we go. So first, let's do this calculation for the payment within Excel. We can see how to calculate the payment, and then we'll have to calculate for each of those payments, those 60 payments, the individual split using an amortization schedule and show how that would be broken out. So let's do that now. This is something that if you don't have this, you can get it from your accountant or your CPA can help you with this. We'll also take a quick look at some other ways you may do this, and then look to adjust it at the end of the year with possibly your adjusting department or your CPA in order to account for the interest portion of any loan, as well as the short-term and long-term portions of them. So if we have the payments is going to be the calculation. One way we can do it here is we can go to the formulas, and we go to this functions tab, and if we type in payment, then that usually brings it up. It's this PMT is what we're looking for. That's the payment calculator. So if we know the loan amount and we know the how many months and the rate, we then have everything we need except the missing variable of the payment for this calculation, and Excel will do that for us. So we're going to say OK, and we get this nice little function entering box that will help us do this. We'll take the rate. It's going to be that 6%. However, we're going to break this out by the number of payments which are being paid monthly. So we really want the monthly rate. So we're going to take that and divide it by 12. That's the trickiest piece of this calculation. Remember, whenever we think of a rate, it means per year. So we're going to divide that out, and that'll give us the rate per month in this case. This is going to be the number of payments, number of periods, number of payments. And we're going to say that that's going to be the 60. It's going to be 5 years times 12 months, which is 60 payments. And then we're going to say the present value is what we have right now, the 72,000, and enter. And it gives us our amount. I want to see it as a positive number rather than a negative number. It puts a negative because it is a payment. In order to flip the sign, all we need to do is go in front of the P in the formula and put a negative. And that, in essence, will take the whole thing and make it negative, or take the whole thing and multiply it times -1, making it negative. Now there's another way you can do that, just to show you how Excel will do that. If you say equals PM, the payments tab, or click on that, then we got this nice little thing down here that shows you what we're working on. So it's actually a quicker way to do it. You can take the rate divided by 12, comma, and then it wants the number of payments, which is that 60, comma, and then it wants the present value, which is that 72. These are not required fields, so we're going to close that up, and that'll be it. So now that we have that information, that's great. I'm going to make it a negative too. I'm going to make it a positive by putting a negative in front of the P, like so. That's going to be our payment amount. Now that's what we're going to write the check for now. We probably already knew that that's going to be in our loan terms. We probably know this information, but we don't know how to split that payment between interest and principal. So let's think about that now. Let's break this amortization table out. I'm going to say the payment amount is going to be this. For payment number 1, we'll calculate the interest as equal to the principal amount times the 5% divided by 12. That's how much interest we should be paying for the first installment 1 month from the date of the loan. If that's the interest amount, the principal then is the payment minus the interest. So the principal is going to be the payment minus the interest. So I'm just taking the B7 minus C7 will give us the principal. Then our new principal amount is going to be equal to the 72,000 minus this decrease in principal. So after our first payment, we still owe 70,941, and we had the payment of 1,359, but broken out between interest of 300, principal of 1,059. Payment 2, if we do that same calculation, we're going to say the payment is constant. That's what we said was going to be constant, but the interest now is calculated on this new lower principal amount, because we're basically paying rent on the lower principal, times this 5%. I'm going to say F4, so when I copy that down, it'll keep that cell. Tab, and then we're going to say principal. Oop, wait a sec. That looks awfully high. And that's because we didn't divide it. I did not divide it by 12. And so there's the new principal. The new interest is a bit lower. There's our payment minus the new principal. There's the principal reduction. And we're going to take the prior principal minus that deduction, and that gives us our new principal. So now of course, the principal is going down, but not by the amount of the payment. That's how much cash went down. 296 of it was interest, and therefore the principal was 1,063. If we do this again, one more time, 3, the payment's the same. The interest now is the new principal times the 5%, F4 to make it permanent. That just means the dollar signs just means I want that an absolute reference. So if you don't know, don't worry about that now. We can look that up in an Excel course. But You need that there when we copy it down, divided by 12. And then the principal deduction is going to be equal to the payment minus the interest. The new principal, therefore, is the prior balance minus the principal deduction. Point being that the interest is going down with each payment as the principal that interest is calculated on goes down, and the principal portion then being applied out, part of the payment is going up. Now I'm going to copy this down all the way down to 60 payments, and we should get to a principal balance of 0 after 60 payments. So let's do that. We're going to copy this down somewhere like around here. There we go. And so there's the 0. So we made 60 payments. It goes to 0 at that point in time. That last payment, we still made the same amount, but the interest portion was only $6. All of it was principal because we only had that much that was being calculated interest on, bringing the balance down to 0. So this is an amortization table. This is what we need in order for us to say, okay, we're on this first payment, and we need to make that payment. We're going to say it's for $1,359. So we're in essence going to just write a check for $1,369. However, we need to split the other accounts between interest and principal. That's what we'll do now. So we're going to go back to QuickBooks over here. We're going to make our first payment. So I'm going to do that. There's a couple different ways we're going to do this. I'm going to do this in the check register, and then we'll actually write a check. So we'll go to banking. I'm going to go to use register. We want to be on the checking account and say OK. Here is our check register. Going to make this payment as of 02/01/21, the first day of the next month. And I'm going to say that that's the check number should be okay. We're going to say that remains the same. The payment is going to go to Chase. We're going to say Chase, and the payment's going to be for the full amount, 1359, the full amount on our amortization table. Now we only have one other account, and this is the problem when entering this data. We need two accounts for it to go to, one for interest, one for principal. The way to do that is you select the split here within the check register, and now you can add up multiple accounts as long as this line, these totals add up to this total here. It won't let you post it if that's not the case. You can't really mess that up. So we're going to say that there's going to be an interest expense portion. Notice interest expense does pop up from our chart of accounts. We had not made that. It was there and generated from when we created this chart of accounts as a merchandising business. And it is an expense. That's what we want. So we're going to say that's what we want. That amount, however, is wrong. It's going to be 300 from our amortization table. And then we're going to say that the other amount is going to go to the loan payable. And so there's loan payable. It's a long-term liability. And QuickBooks figures it out for us. We could have gotten that from the table, but QuickBooks figures it out for us. Now let's just pretend we got it wrong here, and I put 1,000 on accident. And if we try then to record this, QuickBooks is going to say the transaction is out of balance. We're not going to let you do that because it's wrong. And we're going to go, all right, it's wrong. And then we're going to figure this out. The second one, we're going to say that that came from our table of 1059. And that then should match this amount as it does, I believe. So if there's no pennies involved there. So we're going to say record, and there we have that. So this amount has been recorded. If we take a look at what happens then in terms of the financial statements, we can start with the balance sheet, going to the balance sheet here. And we know that the cash went down. Double clicking on cash. We see that cash should decrease by the full amount of the payment. Double clicking on that. We see the check here. Closing this out. Closing this out. We then go to the income statement or profit and loss. We can see the other two accounts, reports, company and financial, profit and loss. We're going to change the date 01/01/21 to 12/31/21. And we're going to look for those two other amounts, one being the interest expense. There's the 300 in interest expense. There's the 300 there. So there's our check. Closing this out. Closing this out. That, of course, decreases net income. And I misspoke before. I'm looking at the balance sheet as the other accounts. Let's go back to the balance sheet. And we're going to scroll back down, and we now want the loan. Here's the loan amount, $70,941. Double clicking on that. We see that check right here. And note we started with a loan of 22, and then we updated our loan terms by the 50 to get to that 72. So we're assuming that the new loan was negotiated at the 72. If we double click on this, there is our data. And if we close out of this, then we could check this by saying that amount should match the amount on our loan table here. So that's how we want to take a look at that. Now, note that if you were to do financial statements, you'd still have an issue that here is in long-term liabilities. And we would have to, after each payment, really, if in a loan like this, is figure out the current portion. So if you were actually to make financial statements, you'd have to be specific and say that there's still these amount of payments that are current, or the principal payment, the principal portion that is current, 12 months out, and take that number. Let's sum it up this way. And that number then is what would have to be the current portion versus the long-term portion of the loan. So beware of that, but just note that the total loan balance is going to be this if we split out between those two payments. So we're going to do this again, and we'll do one more payment as of the end of the month for the second payment, and we'll do that a bit different way. Back to QuickBooks, we're going to go back to the home page, and this time we're just going to write the check. So we're going to go to Write Check to write this second check, and this one we're going to write as of the end, so it's the second payment that we made. Happen to make them in the same month, one at the beginning of the month, one at the end of the month. So we're going to say it's the checking account. The check number should be accurate. We're going to keep that. We're going to say the date, however, is 02, I'm going to say 28/21. And so that's going to be the date. It's going to go to Chase again. And note that we already have Chase set up as an other, not a vendor, not a customer, but other, the person we took the loan out from. The amount is going to be the same, 1359, same amount. And however, we're going to break that amount out between interest and principal, a slightly different format. So once we have that breakout, we can't just copy the last check is the point. We have to go back to the amortization schedule because that breakout changes. The interest now only being $296, and cancel account interest expense tab only being $296, and the principal for the loan, then the difference, this should be $296. And the principal, the loan difference, is 1063. So note they're slightly different. It was 300 before, and it was 1059. Now we have the interest expense 296 and 1063. We're going to save and close this. Note that when you look at the check, we already have those breakouts down here, so we don't have to use the split column. And you got to remember that we're always on the expenses typically, unless we're dealing with inventory when we write a check. So we're going to say save and close, and let's see if that did what we would expect it to. I'm going to say no to the advertisement to get checks, which is a nice thing to consider, but we're not going to do that at this time. And we're going to go to the balance sheet, and scrolling back up, we can see that cash is here. If we double click on cash, we can see that cash has decreased by that same amount, the second payment, same amount. Double clicking on it, there is our check. Closing this back out, closing this back out. Profit and loss, scrolling down to the interest expense, there it is. We see that second check for a slightly different amount. There's our check. If we close this out, back to the balance sheet, and we check the loan balance, we say here's our long-term note loan payable. Double clicking on that amount, we see our check again, decreasing that by a different amount. Double clicking, there it is, closing back out. This is of course in accordance with the amortization table. Closing back out, balance $69,878. If we go back over here, we can see that we're just made our second payment right there. Balance $69,878. Again, if we were to show this to someone else, we would have to then adjust after each time, because note that the amount that's due, the principal portion due within 12 months, changes after each time period. So we'd have to say that the current portion is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 out, and break that portion out as current and the rest of this $69,878 as long-term. In order to show that, we'd have to make that adjusting entry at the end of the month if we were to report these properly in terms of current liabilities versus long-term liabilities. Also note, you might be saying, well, why aren't we adding this up? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. And if we were to do that, it would remain constant given the fact that we're paying the same amount each month. But the reason we don't do that is because this interest expense has not been incurred yet. So as of this point in time, we have not yet incurred this interest expense because time hasn't passed. Just like if we were renting an office building, we're not going to charge the rent that we know we're going to pay in the future. We don't owe that rent yet because we haven't yet used the office building. So these payments include assumptions that we're going to be using or borrowing the money, and we haven't. So we can't record it on the balance sheet as of this date. We can't include the interest portion that is on the balance sheet as of this date, because we have not yet incurred the expense by time passing with which we are using the purchasing power of the money. Gonna pull this back out. So that's going to be the interest calculations. We could set that up. Just note that if you're working with a CPA firm or a bookkeeping firm and you're making payments and you're saying, I don't know that amortization schedule, and maybe that's too complicated and I don't want to make an amortization schedule, then you could get an agreement with your accounting firm, especially if you have a lot of loans. And you might come up to an agreement and say, hey, you know what, I'm just going to post the payments to these particular loans. And you'll see them all there. When you double click on the loans, you'll see all the payments that I've made to this loan. And and I'm going to break out each loan individually. Could be useful, helpful to a process like this, and tell your accounting firm that they need to make an adjustment, or you would appreciate them to make an adjustment at the end of each month in accordance with the portion of this loan that needs to be reported as interest before the financial statements are used to make decisions on, and the current and long-term portion needs to be broken out. So that's another way a system could be set up to run this efficiently. Just say, hey, I'm doing the checks. I write the checks. I'm going to write the checks to the loan, and then I expect my accountant or bookkeeper monthly to go in there and make that adjusting entry on a periodic basis.